paying tax if your profit is between 0 and about 70-something thousand, probably up to 75,000 or so, because you're a small business corporation. And also compliance is important because you have to set up your governance structure in place, because everywhere you go, the first thing that people want to understand about your business is how your governance structure is structured and how your governance is in place, so that they see that there's a very legitimate business that they can trade with or they can do business with. And also for funding purposes, everywhere you're going to go and request for funding, obviously they're going to look for whether or not you've got all your compliance requirements in place. I remember recently we were working on a project with another client. So while we were doing that, we were looking for funding and all of that. And it was a struggle to get funding, simply because some of the compliance requirements that are necessary, it's your financial compliance. Do you have financial statements? Do you have your monthly management accounts and all of that? And it's very difficult in South Africa to get a funding once you don't have financial track record. So because most of the funders, they fund based on the track record. So with us, because we could not find a traditional institution that was able to fund us, then we have to go the angel investment route, where you get an individual who has the money to invest, and then they are not that much onerous in terms of the requirements of compliance that they're looking for. So you are able to get someone who's really not interested much in the what are you compliant on. So the guy was just interested in, because the people that we were working with, those guys, they had already worked on that project. So because there was an experience that was there, and because there was also people that had worked for that company before and they've taken voluntary packages, it meant that there's enough experience to continue the work, because the same people who were working for that company, the project that we are going to be doing, those are the same people that are going to be doing the work in the same project. So the guy was happy, even though we didn't have a financial track record, to kind of like come forward and want to do the investment. So I'm just saying that sometimes you should not let compliance stand on your way, because there are other ways in which you can do some of these things, especially for the purposes of funding. So some of you have also applied a lot for tenders, and you've received a lot of RFQs and RFPs and all of that. So there's a lot of compliance requirements. And maybe if I can just go back to the issue of funding. So recently, I referred a lady to one of, because she wanted to apply for funding for one of the funding institutions, which is IDC, so which is the Development Finance Institute. So most of the time we find that you also need to understand the kind of funders that you are dealing with as to what kind of compliance requirements they're looking for. For instance, with the DFIs, they are very onerous in terms of the compliance requirements that they're looking for. So I had the lady to meet one of the corporate finance specialists, so because he was doing large funding for the IDC. So she was going back and forth, applying for IDC, and they said, we're not happy with this, and she was going back and forth. So when I made her to meet with one of the corporate finance specialists who specialize with structured finance, so the guy came up with an investor pack that shows what is required when you're putting together an investment proposal of that amount, and what are the rigorous compliance requirements that are needed in there. So the lady couldn't believe it when he saw that file. It was a huge file. It was a huge file. So it was the one that he had already done for some of the clients, and it was an investor pack. So it was a huge file. So just to show that if you are going to go the route of your traditional funding institution like your DFIs and all of that, the requirements are very onerous, and especially when you're going to request for a lot of money, you must know that they're going to require from you a lot of documents. So all those things, they need to be in place. So, and most of the time when you're just starting and you don't have much of track record and a lot of compliance stuff and all of that, it's very, very difficult to convince them. because there are all sorts of things that they are looking for in terms of the compliance requirement. So you also need to find out exactly which ones are going to require just what you have. So you can't go to IDC when you know that you are barely starting. So also, being on the CSD requires a lot of compliance as well. Some of you, I don't know how many of you are on CSD, the Central Supply Development. So when you are on CSD, you know that it requires that already you are compliant with some of those areas because you know that it's linked with some of those institutions. I know that some of you, how many of you have received fake RFQs? Fake RFQ. So everyone is crying about the fake RFQ. So the Department of Treasury said that they never send out any RFQs to anyone. So if you receive any RFQs from anyone, then you know that it's not coming from them because they have their own internal processes on how they deal with issues of RFQs and all of that. So also for the purposes of ESD, doing business with corporate and all of that. So I have also found that, I know that this is not maybe popular with everyone. So I have found that it is easier when you belong to a support institution in the form of an incubator or accelerator program or corporate initiative that they do to support small business. When you are there, it then becomes much more easier to be adopted into the enterprise and supply development because then they don't have time to go out and look for small businesses to assist. But when you already belong into a enterprise and supply development program, it becomes easy because now corporates, when they just want to assist entrepreneurs, they go to your ORIC, they go to your Shanduga Black Umbrellas, they go to your Race Corp and all of that because those are organized structures and they are controlled environment where they know that all those institutions that already have done a lot of compliance work so that when they come and do business with those entrepreneurs are already compliant. But when they get you off the street, then they know that there is still a lot of work that they need to do with you. So I know that some of you have had bad experiences. Some of you are saying that the incubators and accelerator programs are not working. I don't know how many of you have been in the incubator or accelerator programs. So quite a few of you. So yeah, most of the entrepreneurs in South Africa, actually when you read up on the Seed Academy report, so it was not quite a nice feedback that has been received on the survey about what entrepreneurs are saying about the support institutions in South Africa. So the feedback was not that good. But I think, I was telling someone that it is true that when you get into an incubator, the reality is that there's no opportunity for everyone. So what if you get there and you become one of the ones? Because obviously, I've also been in one, I remember 2011 and 2012, I was part of the Shanduga Black Umbrellas. So how I have seen corporates coming to assist entrepreneurs was that they were coming into the incubator and said that we are such and such a company. I remember there was and also to understand how the model works, because sometimes they're looking for something that is in line with their supply chain and something that can benefit their company too. And that when you structure yourself to be assisted for the ESD, you should be looking at that angle, that how do I position myself within the supply and value chain of a particular company. So this guy was running a company which is a transport company. So in his transport company, he was dealing with shuttles and all of that. So that was that time when the Gautrain was coming in and all of that. So they needed shuttles for their staff to be transported from Gautrain to their company. And what they did, they bought the guy the shuttles. They bought him a vehicle for free, just got it for free from the company, because the company was going to account for it as the ESG spend. And then what was he going to do? He was going to use it to transport the employees from the company to Gautrain and Gautrain back to the company. So those are the opportunities that you have to make sure that you are aligned with the supply chain as well as the value chain of the company, because they want to put their mouth where the money is. So, is there any questions so far? So, just on the as I said, that we want to also troubleshoot some of the challenges that you are having with your compliance issues. So we have, all of you know the CIPC, which was initially CIPRO, now it has changed into CIPC. So initially, obviously, there were two, there was CIPRO and OSIP. Now, as a commission, and it has been merged into a commission. And just to go through some few aspects on the New Companies Act, just to show you what has come to light. So we were working on the old act, now we're working on the New Companies Act of 2008, so Act 71 of 2008. So they had to amend it because it had to align to international best practices, because obviously the law was outdated, now it had to be realigned into the new business environment. And also to simplify the registration process. And you know, we never realized how in South Africa we are so advanced in a lot of things. So I was attending the company law symposium, and there was a lady from Nigeria who was saying that in Nigeria they are still operating on the law of their Companies Act is Act of 1950. So it has not been adopted to the current business environment. So us is the Act of 71 of 2008, so which was promulgated in 2011. So, and also some of the things that has come up after the Act, we've seen that the simplification of the registration process, and many of you can attest that now it's much more easier to register for a company. And also the discontinuation of close corporation registration. So there is a discontinuation of the CC registration, not of the close corporation, because the close corporations that are there, they continue to exist, they continue to work and function as normal as the companies would do. The only thing is that you can't register a new close corporation, or you can't convert a private company into a close corporation. So, but the close corporation that is there, they are still continuing, because the Close Corporation Act is still in force, it is still active. So, but now it has been brought into alignment with the New Companies Act. So also there was an encouragement for all those who are running close corporation to convert from the close corporation to the private companies. So there was 3 years of having to convert for free. After that, then we had to pay about 250, but now they've reduced it to 100 rands. And also, one of the good things that has come is the business rescue regime. As you know that initially the remedy of the company that is aiding, that is in financial distress, will just be liquidation because of the Insolvency Act. So, but now there is an opportunity for that company to apply for a business rescue process. So I'm bringing this because some of you will be dealing with a company that is in financial distress, that is under business rescue. So you have to know what's going to happen when the company, you are doing business, this company is in a business rescue. What is your remedy? What is your rights? And what is your limitation? So what happened in the business rescue is that the company is in financial distress, is not going to be able to pay or meet its obligation in the foreseeable future for about maybe in 6 months' time. So in 6 months' time, the company will be insolvent. So before it reaches the insolvency, you have to make sure that you apply for business rescue. So a business rescue is a breather where the company gets a moratorium. A moratorium is a breather or a period where the company is given a chance to go through business rescue process, where there's going to be a business rescue practitioner who's a business turnaround strategist, who's going to put the company under administration. So the company now is going to be under the new administration of the business rescue practitioner, who is the officer of the court, who has to make sure that he take the company from the bad financial position to somehow a sound financial position. So in that process, the company is then given some moratorium and a freedom to do what it can do within that specific period. So, but this is not for companies that are really insolvent, because then the remedy would be the Insolvency Act. So this is for a company that has a reasonable prospect of being able to sort out itself so that it can come back into sound financial position. So you must know when you are dealing with a company, you might be servicing a company that is in business rescue, or that is under the business rescue process. So what do you do? What are your remedies and all of that? Because at that time, you are not going to be able to get your payment at that particular time, because the company has to complete, and there are people that are, in terms of the process, there are people that are getting privileges as to this one must be paid first, that one must be paid after the other. So where does it place you? Because now you have done service and then you are being owed, you are a creditor. So what are the rights of the creditor dealing with a company that is in financial distress? So because, and I'm emphasizing this because in the recent training that I did, it was a similar case with another lady. They were stuck, they didn't know what to do. This was the company that they did a transaction with, and all of a sudden the company doesn't have money to pay them because it's in business rescue. And in that case, you can't even institute any legal proceeding against the company because it's protected by the law to make sure that everything is going to be done after the business rescue process is complete. So also, then there's a business tribunal that has also come as a result of the Companies Act. So there's also when there are disputes, within the company in terms of, instead of them being resolved by the traditional courts, so there's a business rescue process, there's a company tribunal process where it's sitting there at the DTI instead of filing for a court process. So you can file for the company tribunal so that you can do a dispute resolution with the company's tribunal. It's much more faster, it's much more quicker, a day or two, the dispute is resolved. When you go through a traditional court system, it can even take nine months just to roll your case into the court and be heard. So that's one of the things that has also made it much more nicer. So there's also the financial reporting standard that has also come with very interesting developments. Now we have the public interest score. So the public interest score has a way of scoring the company according to their public interest. So meaning that, and it's not only for auditing purposes. I don't know how many of you are aware about what takes or what forces a company to having to be audited. Because some of you are wondering, should we be audited, should we not? Our financial statement, independent review, what's the difference, what's happening, and all of that. Okay, so what's happening is that some of the things that has come up with the financial reporting standards in the new Companies Act was a public interest score to categorize the companies according to the size and different stages of companies and all of that. And maybe I can just make it easy for you here. So what happens is that with a public interest score, there are different rankings that they do. So there's a less than, there's less than, let me do this. It's less than 100. There are companies that are less than 100 points, and the ones greater than 100 to 350, and the one greater than 350 points. So for companies that are below 100 points, then their public interest score. So these are the points for public interest score. So how they calculate the score is that for every, in terms of turnover, so R1 million is equal to a point, and then there's also third-party liabilities. So the third-party liabilities, you have also for every R1 million, it's a score, and then you also have the number of shareholders. So the number of shareholders per shareholder is another score, and then you have you have employees. So for every employee is also 1 point. So all of these things is 1 point for the employees, 1 point for shareholders, 1 point for every million of the third-party liabilities, and 1 point for the turnover. So what they do is that they collate the total for all of this. So when it amounts to less than 100, then it means that that company is a small company, is not eligible for the is not eligible to be audited. So if you are less than 100, when we calculate the number of your employees, the number of shareholders, the number of per million rand, and the number of per million rand of the turnover, so that when we collate all of that and when we calculate all of that, if it gives us less than 100, then you are a small company that doesn't have to be audited. And then coming to the second stage, this is now the stage of between 100 and 350. So here, between 100 and 350, you are supposed to do the independent review. So the independent review is just to take the financial statement and just take them to an independent person who will just give an opinion to say that the financial statement, they meet all the standards and accounting standards and everything, and they are okay. So from here, so you need an independent review. So, but if you have prepared the financial statement internally, so you can't qualify for independent review when you get here. So you go straight for a full audit. So, but from above 350 points, then those companies, they have to go for a full audit. So they have to be audited, and it has to be a kind of a fully blown audit. So this is how it works in terms of which companies have to be audited and which company doesn't have to be audited. Yeah?
Basically, mine, I just need an advice for guidance. In my case, we have an NPO. But now, for sustainability sake, we just want to incorporate perhaps a company that will be able to generate profit so that we can sustain the organization. So I just need an advice. What type of an entity as perhaps a subsidiary company that we can incorporate with the NPO so that we can be able to make profit?
Okay, nowadays it has been understood that NPOs and NPCs, they need to have trading activities in order for them to survive. Because it's not about them being fully donor dependent, because it's unsustainable. That model is not working. So, but to the extent that their trading activities are concerned, then that now go into the area of SARS, because with SARS, they call them public benefit organization. So SARS will look at the public benefit activities that we regard this company as a PBO because it has those public benefit objectives. So, but in terms of the tax treatment, that's when they will decide that do we exempt this company or we don't exempt it. So from your side, what you can do is that you can run a non-profit organization or NPC or whatever and look for, you can incorporate trading activities that makes money. It shouldn't be the core business of what the NPC is all about, because trading activities are fundraising mechanisms. They are not the core business of the organization. So you can't sell, and selling is the main thing. So the social objective has to be the main thing, but you are selling something in order to raise funding to fund the social objective. Okay, let me run away from the non-profit. You will come back to me because I'm pressed for time.
I'm still on NPC, I'm concluding. There's often a suffix which...
It's often what?
A suffix.
Okay.
Which is what you call, after an NPC, we have what you call ring-fenced, RF. What does that mean?
So the ring-fence provision is for the memorandum. So you find some memorandum of incorporation at the end at the end of the name is RF. So that means ring fence provision. So the ring fence provision means that the company, and it is not most of the times for profit companies. So it means that the company is ring fence for specific objective, or is ring fence for only a particular purpose. So those are special purpose companies. So meaning that it can be ring fenced to be only a company that manages the share scheme of the employees. So find that a big company will have a registered company on the site, which is an RF company. So that RF company is not for trading; it's just to manage the share scheme of the employee. So that company is ring fenced from trading. You can't trade with that company. So also that's something important to know, that when you come across a situation where the memorandum of incorporation is RF, then you know that there's something that you need to know about what are the limitations of that company, because it's ring fenced from other things. So you might be getting into a partnership or getting into a transaction with that company. If it's the memorandum say RF, then you have to know that that company is limited in terms of something, or it's for a special purpose. So also, I also find when entrepreneurs complete the whether RFQs or whether whatever forms that they are completing, they are struggling to understand the form codes, because some of the companies are still using the old form code. Your CM1, CM5, CM7, CM whatever, CK1, CK2. So entrepreneurs are struggling to. I don't have these things, so only to find that those are the old form codes, and then now we are using the COR. So if you most of the time is COR 14.3, which becomes your certificate. If you have done the amendment, then it becomes COR 39 in terms of director's amendment. So if you have done a conversion, it can be COR 18.1. Then if you've also done other changes, so the form code will change. And also, just make sure that when you submit your documents, submit all of them, because you don't know which ones are required. So whenever you submit, whether for tender or you submit for being in the database of a particular company, submit all your registration documents, because sometimes you submit a document, you are the one for change of address, and then you submit only that one. There's no 14.3. So it's like you have not submitted the company certificate, and that's how you get disqualified for some of these opportunities, because you are not submitting the right forms with the right form code. So there's also something about the annual returns. So now there's a new requirement that in terms of the annual returns, you have to also submit the financial statements. So there's a requirement to submit financial statements, or submit they call them financial accountability something. So it's a new thing that has just come up, that you have to submit that as part of filing your annual returns. And this is not the SARS stuff, because most of the entrepreneurs are confusing the CIPC annual returns and the SARS tax returns. So when someone has filed for SARS, when come the annual returns, the companies is deregistered, they say, but I've been paying SARS. Why my company is deregistered? So there's a big confusion on that. And also, but this applying for, you will see XBRL when you submit your annual return. So the XBRL most of the time is for big companies that are submitting their annual financial statements, where the XBRL is going to be a requirement to convert your PDF financial statement into an XBRL file, because the XBRL is a new technology that the CIPC is using to read and interpret the financial statement. So they want to see when they search for maybe cash and cash equivalent of a particular company, the system should be able to pick up that number. So it's more of a artificial intelligence of the XBRL that they have now introduced. But for small businesses, they are not that much affected. I don't know how many of you have filed the returns recently. Have you done any submission of supporting documents or financial statements? Or you are confused about XBRL and all sorts of things? How many of you have seen that, XBRL? So are you guys submitting the annual returns? You might have come across the whole XBRL thing. So most of the time is for company, again, it comes back to the public interest score that we spoke about. So for a company to submit their financial statement in the XBRL, it is determined by the public interest score. So those are companies that have to be audited, that have to submit in the version of the XBRL. So, but if you are a small business, then there's a form there that they call financial accountability, something that you have to complete and make sure that. So there's also now there's no more need for shell companies, and you rather just go for new registration, and you are able to also register without a name and directors. But there's a time within which you have to make sure that you have completed the directorship and the name of the company. How many of you have K companies? They call them the K companies. It's just a K and a registration number. So the K and the registration number become the name of your company while you have not done your number. I think we'll finish with tax and SARS, but I don't know how much time we have. So the SARS and tax as well, these are mainly the ordinary tax type for small businesses. So if you have to file your income tax returns, so you know that you have to file in terms of the ITR 14 return. And one thing that also confuses a lot of small businesses is the provisional tax, because they file the income tax, but they don't file the provisional tax returns. And sometimes when you have filed the ITR return, you find that the system still says non-compliant. But you are wondering, but I have already filed the tax returns for the year. So you find that when your provisional returns are due, then the system will say non-compliant. And that will also invalidate your tax clearance. The tax clearance that you have submitted for tender, the tax clearance that you have submitted for the for database in companies and all of that. So because now we work with a number, so the number that the tax clearance number that they will have received, when they punch it in, it says that the tax clearance has expired. But your certificate still has the valid date of the tax clearance, that the tax clearance is still valid. But you find that your tax clearance has been invalidated and you don't know. And then you wonder why you are being disqualified for some of those opportunities. So you must be very careful about the provisional tax returns, because it can invalidate. So provisional tax is not a different tax type. It's just a payment method of taking your income tax and then dividing it into an installment of two payable amounts, so that you don't have to pay the full amount at the end of the year. And then obviously some of you might have been registered for VAT. As you know that once you exceed R1 million, you have to be registered by law, and then when you are less than that, you have an option. When you reach 50,000 of turnover, then you have an option to be registered for VAT. But also, it's also not that much advisable for small businesses to be registered for VAT, because of the whole compliance burden that it puts on you, having to submit every 2 months and every 2 months, and then you forget to submit, and all of a sudden there are all sorts of penalties and all of that, and then you can't get a tax clearance, and then it's a problem. So it's always advisable to not register for VAT, but sometimes you find that you are dealing with corporates, or you are dealing with clients that need you to be VAT registered, because they're like, hey, if you're not VAT registered, we are losing a lot of money because of you, because we now can't claim for that. So there are also some of those challenges. But you must also do your cost and benefit analysis to see if it will really benefit you. If it's going to benefit you, you can register. If it's not going to benefit you and it's going to cost more hassle and stress, then you rather stay out of it. Including also the PAYE. Obviously, it's a requirement to be registered as a company, so that you can then withhold employees' salaries and all of that. So, but if you are alone, sometimes SARS would advise that just not to register, and then file your individual tax on your individual capacity. And then the UIF as well, with the Department of Labor and all of that. So obviously, So with the e-filing, it's always also advisable that you guys need to be in control of your own e-filing, just to understand what is happening there, because if everything is controlled by your accountant, sometimes you're not going to be there and they're going to say your tax clearance is expired and you just don't know how to go about that. So you must make sure that you always check the status on your My Profile compliance, so that you see whether you are still compliant and all of that. So that is quite very important. And also in terms of the BE compliance, there are still companies that are looking for the BE certificate, the one that is SANAS or IRBA accredited. So, but it's no longer much of the case, but sometimes you still come across such a situation. So now we know that we only have to do the BE affidavit. Initially, we would also need the EME letter and all of that the accountant will do for you, but now it's no longer a requirement, it's fallen off. At least you no longer have to pay either 250 or 300 just to get an EME. So once you have the affidavit, it's okay, it replaces all of that. So there's also CIPC certificate that most of the time you only get when you do the application while you're there at the CIPC.